The fundamentals of stock market trading. Trading stocks on the stock exchange is both exciting and challenging. Before you enter the stock trading sector, learn everything you can about it. While a stock market in its most literal sense is a place where shares of publicly traded firms are traded, it is easier to understand its fundamentals by imagining a simple system, such as a coffee house. With a plan to expand, the company opens itself to the world and allows anybody who wants to invest in the firm to do so through the first sale of shares or an initial public offering. To begin, the group will promote itself to major financial supporters. If people believe the organization is a good idea, they receive the first go at donating and then support the organization's initial public offering. This places the company on the official public market, where any company or individual who believes the company has potential can acquire stock. By purchasing shares, financial investors become partial owners of the company. Their speculation helps the company grow, and as it becomes more profitable, additional buyers may see promise and begin acquiring stocks. As demand for those stocks grows, so does their price, rising the cost for prospective buyers and increasing the value of the organization's stocks that people actually hold. These financial backers continue to sell and buy sections of the organization at that moment, expecting the value of these offerings later on. This increased income aids the company reserve fresh pushes and also promotes its general market esteem by demonstrating the amount of people who will invest resources into their concept. Nonetheless, if an organization comes to appear to be less useful for unexplained reasons, the inverse can also occur. If financial backers believe their stock value will depreciate, they will sell their shares in the hopes of profiting before the company loses additional value. As equities are sold and interest in the stock declines, the stock value diminishes, as does the organization's properly appraised worth. Unless the company begins to appear profitable again, financial supporters may suffer significant losses. Numerous factors influence the organic market's ups and downs. Market effects such as shifting material costs, changes in innovation, and work-moving expenditures have an inevitable impact on organizations. Financial backers may be concerned about changes in the project, bad publicity, or larger factors such as new legislation and exchange strategies. And, clearly, many financial backers are only willing to sell major equities in order to pursue close-to-home objectives. Every one of these elements creates daily turmoil on the lookout, which may lead businesses to show up with a significant impact. Furthermore, in the financial exchange, seeming to lose respect usually results in the loss of financial supporters, and thus, actual worth. Information about stock trading. Most financial backers would be well versed in creating an improved portfolio of stocks or stock file assets and holding it through various obstacles. In any event, financial backers who choose to engage in the stock exchange more actively. Stock trading entails buying and selling stocks while attempting to timing the market. The goal of stock merchants is to take advantage of short-term market opportunities to sell stocks at a profit or buy stocks at a low price. Some stockbrokers are day traders, which means they buy and sell several times throughout the day. Others are essentially dynamic brokers who establish at least 12 exchanges every month. Financial supporters who trade stocks conduct extensive research, usually devoting hours each day to market monitoring. They rely on specialist stock analysis, which involves graphing a stock's movements in order to identify trading opportunities and trends. Many internet merchants provide stock trading data, such as investigator reports, stock examination, and diagramming apparatuses. The importance of extending. As a financial supporter, you can't avoid bear markets. What you can avoid is the risk that comes with diversifying your portfolio. Enhancement protects your portfolio against unavoidable market fluctuations. If you put all of your money into one company, you're banking on quick growth that might be stifled by administrative difficulties. To reduce that organization's explicit risk, financial supporters grow by pooling several types of equities together, offsetting unavoidable failures and removing the risk that one organization's contaminated hamburger would wipe out your whole portfolio. Building a wider arrangement of particular stocks, on the other hand, necessitates a significant amount of effort, perseverance, and research. A common asset, the previously stated ETF, or a record reserve are all options. These store a container of ideas, so you're subsequently improved. An S&P 500 list reserve, for example, would imply reflecting the existence of the S&P 500 by investing resources into the 500 businesses in the vicinity. The good news is that you can combine different stocks and assets into a single portfolio. One suggestion is to allocate 10% or less of your portfolio to a few of stocks in which you have faith, and the balance to record reserves.